So today our meeting will be for financial planners. This is a guide to reverse mortgage for anybody in the financial industry. So whether you're insurance or a securities representative or a CPA or other financial professional, this is here to help you understand how the reverse mortgage can help your existing clients. And I'm recording this right at the end of 2017. I want you to know that rules changed in October of 2017 and the limits are increasing just a bit in 2018. So I'm going to encompass all the recent changes with, again, one caveat. I know that the limits are being increased in 2018. So with that, I'll just help you understand the objectives today are really to teach, again, financial professionals I should really list, because you don't need to be a financial planner. You could be, again, a CPA, a tax person, a insurance agent, anybody that works with your client's finances. You should understand how the reverse mortgage works. So this is scheduled to be less than 60 minutes. I think we can knock it out in probably a little more than 30 minutes. So you won't need to spend all day with me here. The presentation is designed to help, again, financial professionals to better understand what the reverse mortgage can be used for and how it works as a vital part of the retirement strategy and not just a last resort. You know, a lot of times folks consider the reverse mortgage this product for poor people. Well, the fact of the matter is, if you are in dire need, if you are likely to lose your house, if you don't get a reverse mortgage, then it's too late and you can't get one. They have definitely changed the rules and they do financial qualification these days. And if you're in foreclosure or have been late on payments and don't have any money to support your taxes and insurance, it can be very difficult. The old days, we used to do reverse mortgages for people days before the sheriff was going to auction off the house, and that worked. You can't do that anymore. So with that, I'll jump into this. I really just want to make this kind of a little bit of a premiere, just some of the basics about reverse mortgages first, and then I'll talk about how some of these strategies can really work. So first off, the HECM, or Home Equity Conversion Mortgage, that's the official name of a reverse mortgage. So it's a special type of mortgage that enables homeowners age 62 or older to tap into their home equity. The biggest question I get from everybody, clients and financial advisors alike, is, well, how much can I get? And the answer is you need to get a quote, because it's based on your age and the interest rates and the equity in your home. So all of those things are different for everybody we deal with. So you do need to get a quote, and that's, hopefully you'll do that for any clients that you think this may help. So unlike traditional home loans, no repayment of the HECM loan is required until the borrower no longer occupies the home as their principal residence, or they die, or the dwelling is in default on taxes, insurance, or home maintenance. That's why they went to doing financial qualification, is because if you can't pay your taxes and insurance, the government was, they were foreclosing essentially on a reverse mortgage, and that was giving the reverse mortgage a bad name. So now they do financial qualification to make sure that you can pay your taxes, insurance, and keep your home maintained. So at that time, the lender will declare the mortgage due and payable, and what's borrowed plus interest would be due to the lender. Any remaining equity stays with the estate or the heirs. And, so the bottom line is, as long as they're paying their taxes and insurance and keeping their house up, it's when you move, sell, or die that the loan becomes payable. So reverse mortgages as a financial resource have been around for quite a long time, and we've been using them for years. I've been involved in the reverse mortgage industry since 2002, I believe, and it's been a great tool to help sustain long-term retirement plans for folks over age 62 and help them stay in their home. And the program began in 1988 as a part of the Housing and Community Development Act, and there were some flaws early in the program, and they've all really been rectified. I will tell you, since the major recession, right, the Great Recession, the rules have changed significantly, and every time they change it, your borrower gets less and less money, and it is just not quite as good as it's been in the past. So I want you to keep that in mind. If you have somebody that you care about, if they are thinking a reverse mortgage is something that may work in the future, they're probably better off doing it now and just having the line of credit open so that it can't be changed and reduce how much they can get. So let's talk about the baby boomers turning 62 at the rate of 10,000 per day. I mean, that's a huge number. We're obviously all living longer. Most folks carry more debt. You know, I see people getting mortgages when they're 62, 30-year loans, right? But you have to have equity, and most do have equity. The federal government estimates that 50% of baby boomers have no retirement savings at all, and $49,800 is the average savings for those who have saved. $51,000 is the annual cost of assisted living. So you can see that's a problem. 1 year of assisted living and you're financially wiped out. 23% of married seniors with Social Security income account, they say that's 90% of their income. And 43% of single folks getting Social Security income say that's 90% of their income. That's huge. Healthcare and inflationary pressures continue. The medical costs continue to rise. I know this year, a lot of my clients complain that they saw their Social Security benefit increase, but their Medicare premium increased more, and so they actually got a reduction in their monthly pay. There are really folks where there's really no alternative out there for monthly cash for most folks other than their home equity. They just nowhere else to go. And so, as I mentioned before, the rules have changed. So if you think somebody, a family member, a client, whoever it is, may have a reverse mortgage in their future, they should get it now before they need it. If you need it, if you're really financially tough, in a tough situation, you likely can't get it anymore. And so you can let the HELOC, the home equity line of credit, work for your future. And I'll get into more details, but the reverse mortgage has a line of credit option where it grows, guaranteed to grow by the federal government. It can never be cut. They can never stop it. It's guaranteed to grow at whatever interest we're charging. So it's a really great option. So when you think about home equity, and you go back, home equity was growing, obviously quite nicely until the Great Recession, and then home equity declined. And so if you had a regular line of credit at your local bank, they could have stopped your line of credit. They could have reduced it, all kinds of things. Well, with the reverse mortgage, that doesn't happen, and it would have just kept on growing. There would have been more and more money available for the folks that took out the reverse mortgage and left the money in the line of credit. So, and home equity's been going up quite nicely again. So there's this great opportunity to, again, tap into a larger number and then see it grow from here. So over the last 3 years, the FHA HECM has undergone more changes than in the previous 29 years. I'm telling you, it's been crazy. The changes were designed to protect the consumers and the overall health of the mortgage insurance fund from FHA. I would say that it's really more about the mortgage insurance fund from FHA because they've just reduced how much the borrower can get. So the problem was that, again, people with no means at all would do a reverse mortgage, and then they couldn't pay their taxes and insurance, or they let their home fall into disrepair, and then the lender had to foreclose on it. That was a problem. That's the only way people have ever, been forced into selling their home. There's a lot of wives' tales out there about people losing their homes because of the reverse mortgage. Well, those are the only ways that can happen. You don't pay your taxes and insurance, or you let your home fall into disrepair, and the county, starts getting complaints from your neighbors. That's the only way. So I want you to think about all these changes, and then we'll get into how you can help your clients. So first off, as of today, if a borrower is married, both individuals need to be accounted for in the underwriting decision of the reverse mortgage. And that was not the case back in 2015 until February of 2015. If the borrower's spouse was not of qualifying age when the reverse mortgage was taken out, the guideline prevented the mortgage from being called or due in the event of both borrowers' death. So it used to be back pre-2015 that banks would encourage people to take their spouse off of title And really, even up until more recently, that was done, and that's just a really scary thing, right? So now the non-borrowing spouse or non-borrowing occupant can remain on title. You don't have to take them off, even if they're under 62. Now we're going to consider them, and the loan is going to be based on the youngest person's age. So it will reduce the amount of money that they can get, but no scary removing the spouse from title. Anyway, income and credit being underwritten, this was not the case until April of 2015. So we didn't care. The borrower could have delinquencies, they could be in foreclosure, there was no issues. Now we require the borrowers to be subject to a credit and income underwriting decision. The intent is to, again, minimize the property tax and insurance defaults and help ensure the desired loan is a positive benefit for the borrower. So in other words, the government is saying is if you don't have any money and you're already going into foreclosure, they would prefer that you lose your house now than get a reverse mortgage and lose it later. And it's kind of funny because I think the program was designed for people, at really in a kind of a really tough situation, but it has definitely morphed, and we've seen, in fact, the most recent reverse mortgage, in fact, is closing here this week as I'm recording this. I helped a client they sold their home and got $300,000, a little more than that, $350 out of it, and they're buying a $600,000 house, beautiful home, and using the reverse mortgage, they're going to put down the purchase price from the sale of their home, the $300,000, plus we're providing $300,000. They'll never make a payment on this new home. Beautiful situation. So that's available, I want you to know as well. So the new principal limit and mortgage insurance factors just happened in 2017. This is effective on all cases that were done after October 2nd. And there was another government impact where they came in and they reduced the amount of money that borrowers can get. And that every time I've seen a change since I've been doing this in 2002, it's reduced how much the borrower can get. So again, if you have a borrower or you have a client that should be looking at this, sooner's better than later. So the initial and annual mortgage insurance premiums have changed. So a lot of this is some jargon. I apologize if I get into the mortgage speak and don't explain it well. So basically what happens is the federal government says, if we're going to do a reverse mortgage for you, you have to pay an initial mortgage insurance premium and a continuing mortgage insurance premium so that if you outlive the loan, the lender won't lose money, or if the lender goes bankrupt, you'll still get your payments or still have your line of credit. So it was 2.5% of the maximum claim amount for the borrowers who the first year drew more than 60% of the principal limit, the money that was available. And then 0.5% of the maximum claim amount for borrowers whose first year draw was less than 60%. So if you borrowed $500,000 or your appraisal was $500,000, it could either be $2,500 or $12,500. So you've heard the reverse mortgage is an expensive loan. This is the expensive part. This is the federal government making the borrower insure the federal government against them living too long, essentially. But the borrower doesn't pay it out of their pocket. It comes out of the equity of the house after they die. So it's really money the kids are not going to inherit, if you really want to look at it that way. So under the new rules, it's a flat 2%. So if it's 2% of the appraised value capped at $12,723. And that's based on the current limits of $636,150. So that'll go up a little bit more here in 2018. But, again, it's 2% of the appraised value. You just look at it that way. So it's not... for people that were taking more money out, it's actually better. For people who weren't taking much, it's quite a bit worse. The annual premium has improved a great deal. So it was 1.25% of the outstanding balance of the loan. Now it's going to be 0.5%. That's going back the way it used to be. It actually, a number of years ago, it was 25 basis points, or 0.25%. And, again, they've adjusted it quite a few times over the years. So More upfront, less in the continuous premium. So in the long run, it probably all works out. Depends on how long you live, right? A little mortality test there. All right, so to qualify, the max claim, so right now it's the lesser of $636,000 or the appraised value of your home. The loan to value is based on the expected interest rate and the age of the youngest borrower. And we have to determine how much they qualify for. And so it's all driven, again, based on age and interest rates and home value. So if you had a fair market value of $500,000 and a 72-year-old in the property, if the expected rate was 4.25%, then the loan to value would be 50.9%, so $254,500. If you had a fair market value of $1 million, you'd go over the max of 636 right now. And by the way, I will tell you, yes, we do have private programs that go up to $2 million. So this is just the federal limits on the, again, government version of the HECM. So a 74-year-old in this example at 4.5%, expected rate would be 51%. Loan to value or $324,000. I just tell everybody it's around 50% that you can get. But it really depends on how old you are. If you're 62, it's going to be less than 50% that you can get. If you're 92, it's going to be a lot more than 50%. So it's all this age driven. You need to get a quote. That's the way you find out, right? So the main uses, there really is no limit to how the person can use the money from a reverse mortgage. I will tell you that there are some areas that I know that are inappropriate. And that is taking the money and as a stockbroker, putting the money back into the stock market. That's actually considered a margin loan. And if your broker dealer knows that you're doing that, probably will get into some trouble. Those of you that are insurance licensed, I think most insurance companies have a question on the application that asks, are you taking the money from a reverse mortgage to buy the annuity? Also frowned upon by pretty much everybody in the insurance industry these days. Not that it's a terrible thing, but the idea is you created liquidity. Why would you then put it in something that's illiquid? And then, so as we look at these options, right? So in the first one, the refinance. Typically, you pay off an existing mortgage, which eliminates that monthly payment, and it provides additional equity for retirement needs. Now, here's an idea. So if you pay off somebody's mortgage, let's say they were spending $1,000 a month and you're a financial advisor, you just saved them $1,000 a month. Can you do something with the $1,000 a month to make their life better? Maybe they want long-term care insurance. Maybe they want to have some more life insurance to increase the estate to the heirs. Do you want to invest the $1,000 a month that they're saving? Yeah, that's perfectly fine. You just can't take a big lump sum that we generate from the reverse mortgage and put that in the stock market, right? So there's all kinds of things that you can do. A purchase money, using a reverse mortgage to purchase a home. I already told you about that. This was a great option for some clients of mine. We've done that quite a few times. And, so if you have somebody in that situation, love to help them out. And then the last one, using a reverse mortgage as part of an overall retirement strategy to improve your financial security. This is really a big deal. I've worked with financial advisors for over 30 years, and this is a great strategy. So as you start to look at how you can really impact your clients' lives, get a quote from us and then integrate it into your retirement planning so that you can show a client, hey, here's an option where you can actually just live a better life and enjoy life much more secure. So, and there's a lot of things that you could do with that from that perspective. So there are two types of reverse mortgages. There's a fixed rate and there's an adjustable rate. There's actually two versions of the adjustable rate. The fixed rate is pretty straightforward. It is fixed. The borrowers would like to receive funds at closing with no option of accessing additional funds at a later date. This is good for them. Now, I got to tell you, if they're free and clear, then they're going to get about 60% of what's available, and that's it. Whereas if they do the adjustable rate, they'll get 60% now and the other 40% in a year and a day. So we don't see very many fixed rate reverse mortgages these days. Most times these borrowers, these are best suited for the high utilization loans, like where we're paying off an existing loan and they're not getting any money back. Then this would be a really good option. But we'll run those numbers and help you understand which would be best. The adjustable rate, there is a 1-year LIBOR. There still is a monthly adjustable rate too. Not much point in using it. This is really a better program. And it adjusts annually, has a 5% lifetime cap above the initial note rate. It typically allows borrowers to receive the most funds, and borrowers have flexibility in accessing the available funds. You can take cash at the closing. You can take monthly distributions, kind of like an annuity. You can take monthly payment for life, tenure, that's like a guaranteed lifetime annuity. You can take a credit line where you just say, I want to access money periodically. And you can actually do any combination. You could say, give me $50,000 at closing, and I want $500 a month, and leave the balance in line of credit. We can do all of that. So very flexible, and as you see down there, 90% of all the loans we do are adjustable rate. Not much going on in the fixed world just because it's not as good a loan, quite frankly. And how does the credit line work? The funds left in the credit line do not incur interest until those funds are drawn, right? You haven't borrowed the money yet, so why would we charge interest on it? And it prolongs the equity in the home because you haven't taken it out. We're not charging you for it. It's only available, line of credit will grow over time. So this is a really interesting option. So the funds in the credit line grow at the rate of the credit line growth rate, which is the interest rate on the mortgage plus the 1.25% mortgage insurance, which is changing. So anyway, that's calculated monthly. The credit line growth rate is not interest. I always like to point that out. We don't have the money. The money's still in their house. We're just letting them access more. It's kind of like, I like to envision if you have a credit limit on a credit card of say $5,000 and you're a good payer, you pay your bills in a timely fashion, and the credit card company says, hey, we're going to raise your limit to $10,000. They didn't give you any money, they just allowed you to borrow more. That's what the credit line growth rate is. We're allowing the client to borrow more in the future. It's just tied to an interest rate. So the borrowers have limited availability in the first 12 months, after which there are no more restrictions. They can take it all out if they want to. They can access funds and pay them back if they want to, and then re-access them again. So a lot of flexibility. The credit line grows regardless of the equity position in the home. So even if you just left $10,000 in the equity line, it will grow. The funds are guaranteed and will not be held up or frozen or reduced because of real estate market declines or the home's future equity position. You could let this grow until the borrower's 90 and it could be worth more than the value of the house, and they could pull it all out and give it to their heirs. And there's a lot of really clever strategies that can be utilized here. It's a great hedge against future home depreciation. And if interest rates increase on the HECM, the credit line growth rate increases as well. So it's an inflation hedge. So this is really, I think it's a great opportunity. And once you understand it as a financial advisor, you can see how it really benefits your clients. So if you think about the regular home equity loan, right? This, you have to ask yourself, can you qualify for that? This is much easier. There are still some qualifications, but it's much easier. There are lower fees. Most HELOCs have a limit, term limit. You got to pay it back in 10 or 15 years, maybe 20. They require a monthly payment. You borrow money out this month, you're paying it back next month. The loan can be called by the lender at will in a depreciating housing market. If you'll remember 2008, most HELOCs were closed or the credit line was reduced. There's no security with those programs. As a future planning tool, a HELOC doesn't offer you any assurance or permanency, so it can be closed at any time by the lender, and it's not a retirement tool. It's a short-term liquidity tool. So really quite a bit different than what we can do. So there's been a lot of really positive press. Nobel Prize-winning economist Robert Merton, a finance professor at MIT Sloan School of Management, stated Americans have wrongly steered clear of the reverse mortgage. And I agree. I think you have to look at the home equity in your clients' homes as a tool, just like any other financial tool you offer, right? Stocks, bonds, mutual funds, life insurance, cash value products, long-term care insurance. This is just another tool that can help them live their life in the highest level possible. And so as you look at some of the examples, you could use it as a technique to defer Social Security so they can let it grow. They could reduce the sequence of returns risk. So those of you managing retirement portfolios, you could allow for a Roth conversion at a low tax rate, right? You could have them borrowing money, which is not taxable, out of their home, out of the reverse mortgage, so their income is low, and convert the IRA to a Roth during that phase. And you could reduce their retirement expenses and cash flow out, cash outflow. So a lot of opportunities to, again, use the reverse mortgage to eliminate the income, use it as an income stream to defer Social Security. And this is, you'd obviously have to make sure that your clients are in good health, right? Because you want to, if they're dying, they should take Social Security right away. But if they have a long life expectancy, every year you wait, like from 62 to 70, you've increased your retirement income by 132% over the basic retirement age of 66. Some folks it'll be 67 now, but again, it's just a strategy. And so when you look at this, you can see the remaining line of credit there at $46,000. So we paid off a loan in this example. And we've got a cash advance section there. You can see $21,962 and then $24,000 for 3 years. So we're just deferring them until they're 70, and then they take their Social Security at a higher rate. And I want you to go all the way over to the right and look at that remaining equity. There's still a ton of equity in this house for their heirs. So you're not, leaving your heirs nothing. They're going to get something, so I wouldn't worry about that. They reduce the sequence of return risk. So again, this is a way to, when the markets are down, stop pulling money out of the market, right? If you're pulling money out of the stock market in a declining market, you never are going to earn that money back. That's reverse dollar cost averaging, right? Pulling money out while the market's down, not a good strategy. So the reverse mortgage can be the filler there. So you can see in this example, we came in for 3 years, $27,000, then $36,000 for 2 years. Markets usually recover after 2 or 3 years. So you stop taking money out and you let the line of credit continue to grow. So you can see that remaining line of credit, we tapped into it and then we stopped and it started growing again. So it's there for the next market cycle, right? So you can do this time and again. And then using a reverse mortgage early in retirement can help provide income to allow a retiree to convert a taxable account into a Roth. And the reverse mortgage, again, it's not taxable income. And so the retirees can defer accessing the funds in the retirement plan until age 70 and a half and beyond. They don't have to ever touch it once you get it into a Roth, right? So it's just a way to keep your income down while you convert your traditional IRA into a Roth. And so a lot of other things too, reduce the expense and outflow. Eliminating a monthly mortgage payment has historically been the primary motivation of getting a HECM. Getting out in front of the monthly bill typically allows them to immediately work in the black. Eliminating this payment early before full retirement can allow a HECM borrower to fund heavily into their other financial investments and allow the credit line growth rate to begin to work so they can really establish a nice, comfortable retirement plan. If they wait until they stop working, everybody just thinks waiting is somehow better. It's better to plan, right? If you're a planner, they should be planning. And by doing this approach early, you can really build up a nice cash flow. So I'm going to jump into a little more detail, and this one is showing us paying off a $125,000 mortgage. You'll see that up in the left-hand side, about the 6th item down on the left. And then as we come back down to the remaining line of credit, you can see this growing. So by the time they're 75, we've built up $202,000 that they can access if they need to. And you can see it continues to grow. So this is a real big opportunity to provide a good source for their future retirement. And the earlier you do these things, the better off it is. If you want, we can set it up to where we can even pay the taxes and insurance. That's that LISA payment. So we're actually pulling money out of their equity line to pay their taxes and insurance. And I do have a lot of clients that like that. So they have zero house payments of any kind. No tax, no insurance. We got the whole thing covered. So there are some estate and family concerns that certainly you want to have conversations with. You are depreciating a little bit. It's a negative amortization loan, so you are pulling equity out of the house. And so you have to make sure that the family's okay with that. They understand the situation. With an adjustable rate loan, if interest rates go up, you're going to depreciate the asset faster. If interest rates go down, then slower. And so, but you have flexibility, and that's the beauty of this. And remember, if interest rates go up and you have the money in the line of credit, then the growth on the credit line goes up too. So you grow the money available faster. And when mom and dad die, the family members can purchase the home at 95% of the current market value. So they could still get some money out of the loan. And it's a non-recourse loan. Nobody's ever going to be responsible for it. It's the home alone stands for the debt. That's it. No one will ever make a payment. Again, when mom and dad die, you can sell the home and pay, or you can just give it back to the bank. You can say, hey, we don't think there's any equity. We don't want to deal with it. So it really is a completely flexible, non-recourse loan. So loan maturity, again, it occurs when the last remaining borrower no longer occupies the subject property as their principal residence. And all HECM notes indicate that the loan is due immediately upon the loan maturity. However, the standards allow 60 to 90 days and extensions as needed to arrange for loan payoff. In fact, they get up to a year. So they are extensions, but essentially they'll give them up to a year to figure out, are we selling it? Are we refinancing it? What are we doing? And then if the family chooses to do nothing, if they just say, hey, here's the keys, that's fine too. They have no liability at all. So how's it going to help your business? Well, you can get the HELOC and growth rate to work as soon as you can for your clients, right? It kind of does this reverse the conventional wisdom. We believe that the sooner you do this, the sooner you can actually improve your client's life. You can defer Social Security. You can reduce the sequence of returns risk. You could use this as a tool to work with realtors. It's a way to open up markets with realtors so that you could partner up with realtors and help do financial advising for their clients, right? Help them buy houses with the reverse mortgage and you manage their money. It really is. As you kind of think outside of the box, there's a lot of things that you can do with the reverse mortgage to secure the retirement lifestyle of all of our clients. And you can eliminate current mortgages, retain the cash in your retirement plan, which I think as financial advisors, you'll want them to leave the money in the plan that you manage, right? And with the new principal limit factors, there is some financial qualification. That's just a reality that we all face. And so, I wouldn't overthink that. And so at this point, I'd just say thank you for attending. And there are links on the page that you can click on if you'd like to get a quote, or if you want information from us, we'd be happy to provide that for you. So thanks for listening.